So, welcome everybody to today's webinar. Today we are going to discuss about structured notes. So it is little known type of investment instrument which is available, but not many people know about it. The only reason being that it is only available through registered investment advisor. So it's not available open in market for everybody to invest in. So those who are working with a financial advisor, they can have access to these kind of notes. And I thought that in current market scenario, it's very much relevant. And so I wanted to share a little bit about it so that, we become aware. And if it fits in our overall planning, then maybe can make use of it. So just a front of the webinar disclaimer that this is only for information and education purpose. It is not any advice or a sales recommendation for anything. So any decision to invest should be taken in consultation with financial advisor and considering your individual financial goal. So today we are going to mainly focus on structured notes, and there are three types basically. First one is the income or yield notes. So these are the notes which are focused mostly on giving income on a regular basis, either monthly or quarterly. So there are people who invest in CDs and which may be paying out monthly interest or maybe paying out at the end of the tenure, or they are having bonds which is paying them monthly interest or dividends, or people who are investing in a portfolio of dividend stocks or mutual funds which pay them regularly monthly or quarterly dividends. So for such investments, income and yield notes can be very useful. Then the second type is growth note, where you can have a growth over a period of time, and you won't get any periodic payments. So you won't get any dividends, you won't get any interest or anything like that, but you get paid at the end of the note depending upon the growth which is achieved. And the third one is principal protected, where it's just like become a CD kind of thing where you invest it for a particular period and your principal is 100% protected. So there is no risk of losing the principal, but how much you will get, that will vary. So these are basically three broad categories in which all structure notes fall. So why we are discussing about this now? So in today's market scenario, like or at any point of time, it becomes very relevant, especially in today's time when market is so volatile. We have been seeing that ups and downs in the market, both in bond market as well as in the equity market. And there is a lot of uncertainty, both internal and external factors in terms of political stability, geopolitical issues, inflation, debt level of the government, job scenarios, inflation. So many moving parts, and every news which comes, which either affects it market positively or negatively. And then we see huge swings in the market, like it's going up and down by a good percent point, like on a daily basis. So if we have this structure notes in our overall portfolio, then it can give us a strategic direction. It can give us a way to deal with this market volatility. Second thing is that they are very flexible. So they offer either full protection on principal or partial protection on principal, depending upon our risk taking ability, so that we can choose which side we want to be. Either we want to be in 100% principal protected, or I want to protect my principal up to certain extent, but I can take certain risks. So that way we can customize and we can have the flexibility on our side. While in a pure equity portfolio, you have absolutely zero protection. Whatever market does, you deal with that. And similarly, in bonds portfolio, you just have the fixed rate of return. Upfront that, hey, this is the coupon rate I'm going to get. So there is nothing less, nothing more. So again, you are restricted there. And third thing is that it can provide the diversification. So it's not wise to have 100% of your investments into structured notes. I'm not saying that, but it provides a good diversification tool. So where you have some equities, you have some bonds, and you can throw in a structured notes in the mix, where it provides a good tactical, strategic, as well as a flexible solution to manage our wealth. And as I said, like there are various levels to protect principal. Either we can have a full principal protection, so that we don't lose principal, or we can go to the no protection at all, where we can lose our entire principal, if markets behave in that such a way. Uh, so there is a whole spectrum available, and we can fit ourselves anywhere in between, as per our needs. And again, as saying goes, the more the risk we are willing to take, the more the potential of return is, and the more we want to protect our principal, lesser the potential of the return. But nevertheless, options are available. And one more thing is that we can design our own note, with a minimum investment of 250K. So if somebody has, or a couple of people or three people, have around 250K worth of investment, then we can customize our own notes. We can define, hey, how much principal protection I want, what kind of, and once we go deeper into the next few slides, you will understand what the design features are, and then we can design our own. So that gives us like full flexibility. So before we get into individual specific types of notes, let's first understand few terms which we will be using throughout the slides, coming forward. So I want to discuss these terms before, so that we are on same page, and then it becomes easy to understand what is going to come next. So first term is callable. So I'm not sure whether you have heard this term before or not, because it's not common for the fixed TDs and the investments like that. So what it really means is that whoever is issuing these notes can call the note before its maturity at will. So that means, let's say if there is a note for 3 years, and issuer says that, okay, after 1 year, I can call it anytime. I can call it either anytime, or I can call it at a monthly interval or a quarterly interval. And when it says that issuer can call it, it means that it can prematurely terminate the note. So even though note is for 3 years or 4 years or 5 years time horizon, after a certain period, they can call it and close the note. So they will pay out whatever you owe, or you are designated to get by that time. Generally, in case of call, you get full principal and you get the interest up to that point. So that is one thing. Then there is another thing which is called as auto call. So in callable note, it is as per the discretion of the issuer. He can decide to call or not to call. But in case of auto call note, they will get called automatically based on certain condition, and that will be predefined. So you will know upfront that in what condition, at what time, my note can be called. And this feature is given to protect the risk for both the issuer as well as to the holder of the note. And we will understand how it works as we get little deeper. But so basically, call means that note can be prematurely closed. That's the basic meaning of it. And this is only applicable for yield or income notes. This is not applicable for growth notes. Then there is another term which is called as a buffered note or a buffer. So that means that we won't participate in loss up to the buffer percentage. So if a note says that it has a 20% buffer or a 30% buffer, so what does it mean? That if market goes down by 30% or 20%, then I don't participate in the loss. I will not lose anything. But if market goes below that, then I will participate in the loss. So let's say if it is a 20% buffer note and market goes down 30%, then I lose 10% only, because I have a 20% buffer. I have 20% protection. Similarly, there are barrier notes where your loss is protected up to a barrier percentage. So let's say if barrier is 30%, that means if market goes down up to 30%, I will not lose anything. But if it goes beyond 30%, let's say if market goes down by 50%, then I may lose 50%. So beyond the barrier, I will participate 1 to 1, but up to the barrier, I'm not losing anything. So once the barrier is crossed, it means barrier is broke. So that means I will lose as per the market return. And then there are dual directional notes in which you get the absolute return even in case of negative return up to a set percentage. So let's say if there is a dual directional note of 20%, then it means that when market goes down by 20% or let's say 15%, then you will get 15% return. Even if it is negative return in the market by 15%, you still get 15% positive return. But once it breaks that percent barrier or above that zone, then you participate one-on-one in the market loss. So these are the key terms which are very crucial to understand what's going to come next. So if any point you have any questions or if you're not understanding, you can put a comment in chat or you can unmute or ask so that it becomes clear. So let's discuss the first type of note, which is the yield or income note, or sometimes they are also called as market link CD. So the key features of it is that it pays much higher coupon compared to bank CDs. Since we are taking some risk, now risks are of two types. One risk is that we may lose principal, and second risk is that we may get less return in our interest than what it is stated if market doesn't perform. So since we are taking these two risks, then obviously it has to pay much more to me to compensate for that risk compared to the bank CDs, which are fixed, have no variations. If I buy a 3-year CD, then I know upfront how much I'm going to get, and it's FDIC insured, and I'm going to get it for sure. But since we are investing in this yield or income notes where we are taking some risk, so obviously returns will be higher. In some cases, much higher as compared to traditional bank CDs. And how much we get is linked based on the underlying stock or index performance. So for each note, there is always an underlying stock or underlying index, and that can be anything or a combination of few stocks or few indexes, and we will see in examples. So, and as I said, like once we have up to 250K, we can pick our own stock or our own indices which we want to track. So whether you want to go for S&P 500, you want to go for Dow Jones, you want to go for Nasdaq, you want to go for any other custom index, or you want to go for a certain stock, let's say Amazon, Microsoft, Google, or you are betting on, let's say, Nvidia or Tesla. So like that, there is underlying stock or underlying indexes on whose performance this will be tracked. And as I said, these are mostly callable, and we can have a principal loss at the end of maturity if not called before. So when it gets called, it's 100% principal protected. But if it does not get called and if you reach to the maturity, then there is a chance that we may lose a certain percentage of principal. So let's discuss few scenarios here so that it becomes very clear to us. So this, let's say this hypothetical scenario where underlying asset is S&P 500, Russell, and Dow Jones. So there are three indexes which are the underlying asset for this particular note. This term is 18 months, and the call feature is that it is auto callable quarterly after 6 months. So first 6 months it cannot be called, means it will not close. So it will run for minimum 6 months, but after 6 months it can be auto called if all the indices are greater than or equal to initial value. So we buy this note today. Let's say if S&P is at 6,000, and after 6 months, let's say it is at 6,100. And similarly, Russell is also above today's value, and Dow Jones is also above today's value. And if all the indices are greater than the initial values, then automatically it gets called. And we get the interest for first 6 months, but after that, we get our principal back. And then it has a barrier amount of 30% protection observed at maturity. So protection is only at the time of maturity, which is 18 months in this case. So we have 30% protection on principal. So if market, let's say all of these like worst performing indices out of these is minus 30% after 18 months, then we don't lose any principal. If it is more than 30%, then we have a chance of losing principal. But what return we are going to get? Return we are going to get on it is 10%, like 2.5% every quarter. So it's like almost double of market normal bank CDs. So normal bank CDs are is today giving like around 4.5 for 18-month CD. In this, we are going to get 10% return. Yeah. So let's consider what could happen, like various scenarios, what could happen. So let's say first scenario where nothing gets, nothing happens. Yeah, all the three indices are above the barrier. So here barrier is minus 30%. So as you can see, all three lines here. So all three lines are above the barrier for entire 18-month period. So that means we get coupon every quarter 2.5%, and our total return is 15% and 100% of principal at the end of 18 months. So we don't lose anything, but we get 15% return, and we get quarterly payments of 2.5% every quarter. Now let's say second scenario in which it gets called after 6 months, because as I said, first 6 months it cannot be called, but after 6 months it will get called. So in that scenario, we get first two quarterly payments of 2.5% because market is above barrier. So we get 5% return. And then at the end of third quarter, it gets called. So we'll get the coupon for that also. So we get 7.5%. And then after that, it gets called. So we will get full principal plus 7.5% return in this case. And our contract note will end at the end of 9 months instead of full 18 months. Now we can miss some payment in between if it is not getting auto called. So let's say indices move below the barrier. So in this case, let's say Dow Jones below moved in quarter three, it's moved below 30% barrier. So in that case, we will not get any coupon in that particular quarter, but we will get coupon in next quarter if it goes up. If it remains below, then we may not get any coupon in that quarter. But if it moves above by that time, then we will again start getting the coupon. So in this case, we'll get 12.5% return because we missed only one quarter, and then we'll get our 100% principal back. Similarly, let's say fourth scenario, where at the end of maturity, the barrier is breached because indices, worst performing indices, out of three, at least one indices is below the barrier. So as you can see here, that green dot is below the red line at the end of the maturity. So it has gone down in between also. So we missed the coupon for that quarter three, but then at the end also, it is below the red line. It is below the barrier. So in this case, we got 10% return, like we got four coupons. So we got 10%, but then we will have a loss on 1 to 1. So since barrier is crossed, in this case, let's say it was at minus 32%. So we have a potential to lose 32% of our principal at the end of maturity. But we got 10% return in between. So it will be like that. So these are like four possible scenarios which can happen during the duration of the entire note. And as I said, like in most cases, if there is a loss scenario is happening, then most probably it gets either auto called or it gets called by the issuer, so that the customer does not get any principal loss. So that's how they are designed. So generally to protect, unless there is something very drastic happens in the market, mostly these will not give principal loss, and they will get called early instead of hold till maturity. So here are some examples. So this is a note which is based on NVIDIA. So that is the underlying stock. It is for 18 months duration. Non-call for 6 months means first 6 months it will not be called, but after that it can be called. And then it has a 50% barrier. So that means we are protected up to 50% loss. So let's say if NVIDIA today is at $150, we buy this note. So if NVIDIA go below 75 after 18 months, then we have a chance of losing principal. Otherwise, we will not lose the principal. But in that case, we will get, if that does not happen, then we will get 14.15% annual return on this note. Like that. Similarly, this another example, second one. So here is the combination of three stocks. You have NVIDIA, you have AMD, and you have Tesla. And this is for 3-year duration, which is non-called for 1 year, means you will keep it minimum for 1 year. But overall duration is 3 years, and then you have 40% barrier. That means you will not lose your principal if any of the stock is not down by more than 40% from today's value if we buy it today. But you get return of up to 22% per annum, which will be paid out monthly. And when it says with memory, it means that if you miss any coupon in between due to stock was down below the barrier, then and if it goes up by the next monthly coupon payment, then you will get missed payment also. So you will get payment for 2 months in that month. And as you can see, if it is a single stock, then risk is higher, so that barrier is also higher. If it is a combination of stocks, then your barrier is generally low comparatively. And if you go for indices like S&P 500 or Nasdaq or Dow Jones or things like that, then your barrier would be even lower because chances of falling the indices by such a huge percent like 40%, 50% is very rare. While individual stocks can definitely fall to up to that level, there is a good probability of that in a volatile market. But again, you will see returns on index based underliner will be lower as compared to returns on individual stock based underliner because, as I said, more risk, more gain. Now, let's say if we don't want any risk on our principal, we want at least principal to be 100% protected. So that is another kind of note which is called as a principal protected note or PPN. So in this, you will have 100% principal protection via FDIC insurance up to 250K per note per individual. And then you get only one payment at the maturity. So you don't get any monthly or quarterly payments in between, but one lump sum payment at the end. And in this, as you can see, let's say if you have indices, it is SPXSP, that is S&P Futures Index, and it is for 3 years of duration, 100% principal protected, uncapped, that means you can get unlimited return depending upon the performance of these indices, and you will get 1.17 times of the return. So let's say after 3 years, if this indices is 20% up from today's level, then you get 20 multiplied by 1.17. That would be your total return. If it is up 100% in 3 years, you get 117% return in 3 years. But if it is down, then you get your full principal back. You don't lose anything. Similarly, instead of indices, let's say you have stocks, a combination of stocks, Nvidia, Tesla, Amazon. Again, for 3 years, 100% principal protected. If all these stocks, like any of these stocks is down in 3 year time horizon, then you lose, then you don't lose anything, but you get your 100% principal back. But if these stocks are up in 3 year time horizon from today, then you get 1.385% of the least performance. So let's say out of these three stocks, let's say Tesla rise 20%, Nvidia rise 30%, Amazon rise 20% at the end of 3 years. Then the least of the three, let's say 15%, you will get 15% times 1.385. That would be your total return. So this can again be a very good way of investment because principal is 100% protected, so you're not losing anything. But there is very good probability that in 3 year or 4 year or 5 year time period, whatever we are looking at, these indices or stocks would be up from their current level. And if they are up, then we are getting 1-to-1 return or maybe more than 1-to-1 return because here we are getting more than 1-to-1 return without taking any principal risk. So it's a win-win on both fronts. If market goes down, we don't lose anything, but if market goes up, we can get more than the market return without taking any risk on our principal. Then comes the third type, which is growth notes. So the basic features of these are that like provide the growth option with desired principal protection in terms of buffer, barrier, and dual directional. It can have a duration of anywhere from 18 months to up to 6 or 7 years, anywhere in between. And it can have a one or a basket of underlying or stocks. as we just discussed. It can be a combination of either one stock, few stocks, one indices, or many indices. And it's a great alternative to manage risk if anyway investing in market. So let's say if somebody is anyway invested in market, in indices and things like that, then this is an alternative way to manage risk, because as I said, if you are in market, then you are 100% subjected to risk. There is no protection at all. But here we can have a protection in terms of barrier buffer, and we can protect our losses up to a certain extent. Or we can use it as a hedge against a large stock or index position. Let's say somebody is having in their RSUs, let's say they have a huge position, let's say 200K worth of Microsoft stocks, or 300K worth of Apple stocks, or Amazon, or whatever your company stock. But you want to hedge against it, because what if your company stock goes down in future, and you want to make sure that in that scenario your other investments do good. So then you can have that stock as an underliner, and then you can design a note that if it goes down, then at least I'm not losing anything, or I protect my loss up to a certain extent in that case. So in this also, there are variations. So as I said, like first one can be a buffered note. So these are like most conservative. So again, as a very simple example, like underlying index is S&P 500. Its duration is 2 years. You get participation rate of, let's say, 200%. That means whatever is the return, you get double of that. But maximum return is protected, set as 25%. So in 2 year time frame, you cannot get more than 25%, and you have a 10% buffer amount. That means you cannot lose more, like you will not lose first 10%. If in 2 years, if index is down more than 10%, then there is chances of losing the principal. So again, four scenarios here, same. Let's say first scenario, S&P give 100, like 15% returns in 2 years. Since it is 200% participation, maximum cap is 25%. So we get 25% return in scenario one. In scenario two, let's say S&P is up 5%, we get 200% of 5%, that is 10%, which is less than maximum return of 25%. So we'll get 10% return. In third scenario, it is in the buffer zone. It's negative, but it's in buffer zone. So we get full principal back without losing anything. Even though S&P is down 5%, we will not lose anything. We will get our full principal back. And in fourth scenario, let's say S&P went down by 25% at the end of 2 years. So since we have buffer of first 10%, we will lose only 15%. So our total loss would be less by 10%. That is the buffered amount. So in all four scenarios, I think except first one, where like in all four scenarios, we are better than the market. In first scenario, if we would have invested in market, we would have got only 15% return, but here we got 25. In second scenario, we would have got only 10% return, but we got, 5% return, but we got 10. In third scenario, we could have lost 5%, but we lost nothing. And in fourth scenario, we could have lost 25%, but we lost only 15. So in all four scenarios, we win as compared to the market. Next type is a barrier note. Again, very simple hypothetical example. Underline is set is still S&P 500. Now let's say term is 5 years. Participation rate is 150%. That means we get 150% return, whatever index return, and it's no maximum return cap. So that means we can get unlimited return depending upon the market performance. And then barrier percentage is 30%. That means we are protected up to first 30% of the loss. So again, same thing. Let's say first scenario, in the end of 5 years, S&P is up 10%. So we get 15% return because participation is 150%. In second scenario, S&P is down minus 20% at the end of 5 years. But since we are in buffer zone, we don't lose, barrier zone. So we don't lose anything. We get our principal back without losing any principal. And in third scenario, let's say S&P is down by 45% at the end of 5 years. So in this case, we lose 45% of our principal. because we broke the barrier. But as you can see, over a period of 5 years, going down by like 30% over a 5 year period is a rare event, especially for S&P 500 kind of indexes. In individual stocks, it can still happen, but for indices, it's very unlikely. So generally, when these notes are designed, they are designed, the buffered percentage and barrier percentage are defined such that probability of uh, beating them is minimum based on the history and the normal outlook of the period, like 18 months, 2 year, 3 year, 5 year, whatever period we are looking at. Based on that, the probability is minimum, but still it cannot be ruled out 100%. Then another type of growth note is dual directional. So in this type of note, again, simple hypothetical example, underlying asset is S&P 500, term is 2 years, absolute return on downside is up to the barrier level, participation rate is 100%, maximum you can get is 24%, and the principal barrier is 30%. That means your barrier we have is of 30%. So again, scenarios wise, let's say after 2 years, S&P is up 35%. But since our cap is 24%, so we'll get 24% return and we come out 100% principal plus 24% return and our note gets closed. In second scenario, underliner is negative. S&P has given minus 10% return, but since we are in the barrier zone, we get plus 10% return because it's a dual directional. So as long as we are in barrier zone, even negative will give us positive return. So in this second scenario also, we get plus return because we are in barrier zone. But in third scenario, let's say S&P is down by 35% at the end of 2 years. So then we lose 35% of our principal. So only in third scenario, we will match the market performance. But in other two scenarios, we will be not losing any principal. And again, these are like simple examples just to understand. And as I said, like large variety is available and it can be customized as per our need if we have the capital. If not, then still there are multiple options available to choose from. So again, some examples to showcase. So this is a growth note. In this underlying is S&P futures. The term is 2 years. It has 20% hard buffer. That means first 20% we are not participating in any loss. And then upside protection is 1.3 times. So whatever the index returns, we will get 1.3 times of that, maximum up to 32.5%. So in a 2 year, maximum return we can get is 32.5%. Minimum we can get zero, like getting principal. Sorry, in 2 year period, if index is down by 20%, then we will get our principal back. But if in 2 year period, index is down more than 20%, then we may have some principal loss. Similarly, this next one is for longer duration, 6 years. So as you can say that, see that the barrier is also higher here, 50% barrier. And then upside protection participation is also much higher. It's 2.23 times because it's for longer duration. And again, return is uncapped. So if it goes up, then we get 2.23 times of whatever returns the index gives. But if it goes down by more than 50%, then we will lose. Otherwise, we don't lose anything. So one of the very simple example. So just a final thought. Like the actual note availability vary greatly depending upon the market conditions, and these are generally available for few days at the time of issue. So every week, new notes are issued, and they are available for a couple of days to invest when they are launched. So they are not like continuously tradable or like stocks you can buy it anytime when you wish or sell anytime as you wish. So that kind of scenario is not there. Once you buy it, most likely you have to hold it for the entire maturity period unless and until it gets called in case of yield note. But there are plenty of options to choose on any given day or of the week. There are like at least 60, 70 different notes are available at any point of time for us to choose from. And as I said, if we have 250K minimum, either individually or as a group, then can design our own. And we can define our own underliner, we can define our own time duration, our barrier, and everything. And it can be invested only through RIS, registered investment advisor. So they are not available to invest in open market. It can be invested either in IRAs or any old 401k accounts which you want to migrate and move into structured notes, or you can buy in it in individual brokerage account as well. So it is just a replacement of your stocks and bonds and CDs. So there is no restriction like what kind of money can go in, pre-tax, post-tax, all kind of money can go into it. The minimum investment in any existing notes if you want to invest is 1,000, but that's the minimum. So overall, it is suitable for anybody who has a lump sum in cash, money market, or bank CDs sitting idle, not invested and just keeping in bank. Now interest rates are falling, so the returns on cash will going to go down further, and then you are paying the full tax on whatever you are getting from that. So your net return is even lower if you are holding cash either in money market or bank CDs or in bonds. And if you are willing to take calculated risk in terms of your time horizon and your individual needs, then this can be a very great way to invest and benefit from it. And it will have some fees and charges because it has to be done through registered investment advisor. So it will have a charge of around 0.85% to 1% per year. So that's the kind of minimum charge which need to be paid, which will be paid out monthly on a pro rata basis for the entire duration of the note. So these are some of the points I wanted to share. And this is a detailed disclaimer at the end. It just highlights some high level of risk which are associated with this kind of notes. And as you can see here, like these are generally issued by banks and financial institutions like JP Morgan, Morgan Stanley, Goldman Sachs, and in the previous example, which we saw, this HSBC, BNB Paribas. So all these are like issued by some very, very reputed banks and financial institutions. So the chances of credit failure, like credit risk that these banks go collapse and they failed are very less, but nonetheless that risk is there. If they fail, then our investment may be at risk, complete risk. So accepted principal protected note, we don't have any official protection from government or FDIC on this kind of investment, and it is subjected to market risk and volatility as far as risk is concerned. But as I said, based on the design and based on our individual risk and time horizon, we can still benefit from it. It has a place in individual investment portfolio. Just want to end with this. Like, if you like the presentation and if you want to contribute to save cows and you love cows and if you want to help, you can make your contribution to Veda Foundation project in D-Land, where we are serving cows for their entire life. And donations can be made either through Zelle or PayPal to info@vedafoundation.net. And if you have any further questions for me, you can always reach out to me either by phone or email or on WhatsApp, and we'll be happy to discuss further and answer any questions you might have. So with that, I can end here. And if anybody has any questions, comments, we can discuss.
Hare Krishna, Prabhu.
Yes, Hare Krishna.
Accept humble obeisances. All glories to Srila Prabhupada.
Okay.
Are you? Sorry, nice presentation. One question: the 0.5 to 1%, is that on the principal or is it on the expected
On the
returns?
principal.
on the principal. And
Yeah, and that's a yearly charge. So let's say if you have a 5-year note, then maximum charge would be like 5% of your principal, like 1% every year.
oh, I see. Okay. And you mentioned, while the others are subject to tax, like the
Hmm.
CD, etc., this is not.
Yeah,
Is-
so this will be subjected to long-term tax because most of these notes are more than 18 months,
Mhm.
like minimum, like generally they are for 18 months minimum. So whatever, like on income note, the income would still be taxed as the income, interest income, because you are getting monthly and quarterly returns. But on growth and principal protected notes, if you get one lump sum at the time of maturity, in the end of 18 months or 2 year or 5 year, whatever, that will be taxed as a long-term capital gain tax, which is much lower as compared to your individual income tax rate. So that way we have a tax efficiency here. So let's
I
say
see.
you are have a 18-month CD versus 18-month note. So you will have a better tax efficiency by putting it into a principal protected note versus doing it on a market, like bank CD.
Yes. Okay.
Yeah, because there
Got
is
it.
no interest accrued here, because on CD, even though if you're not getting a interest in hand, you are having a cumulative accrued CD, still you are subjected to pay tax on the accrued interest at the time of filing return.
Understood. Thank you for clarification.
Yeah. Yeah. Okay. Any other questions? Okay. If not, okay. If there are no questions, we can end it here. Thank you everybody for joining and giving your valuable time. And I will put the recording of this in some time so that if anybody you want to share it with or want to listen again, you can do that. Thank you so much.
Prabhuji,
Hare
is
Yes,
is
sir.
that you're saying like you're not that agent, or we need to approach somebody else for this kind of things?
No, I am a registered investment advisor. So if anybody would like to invest, that you can do it through me.
And the uh, it will be through your company, or how is this going to be like?
Yeah. Yeah, it will be through my company. So I have a tie-up with Tucker Asset Management. I'm a registered investment advisor with them. So we will be investing it through them.
And it's not like through just one firm, right? It is like we can
No.
have access and.
Yeah, you will have an account. So as I said, like this is just like a you have your brokerage account. So you will have a account with Charles Schwab, and you will have access to it. You will have your own login and everything. And once you purchase the note, it will be shown there as a security.
And
So
it can notes can be modified anytime, or
no,
over the.
no. Once you buy it, then it's set. You get the initial terms and conditions. They are all predefined. So during the duration of the note, nothing can be changed.
18 months is minimum duration, you said.
Yeah, 18 months is minimum, and maximum is about 6 to 7 years maximum.
And you suggest long term, or how is it?
It all depends to individual, depending upon when you need the fund, how long you want to hold. So it all depends on individual
So
financial
it's not
situation.
like I mean, there is no recommendations on this. Like minimum,
Yeah,
uh,
no, because it's all individual scenario dependent. That's why it has to be invested through a financial advisor, because then that person can evaluate what that kind of duration and what kind of risk fits in your overall profile. And based on that, recommendation can be made whether you should go for this or that. You know.
money. I mean, this whole purpose is like to get more money, right? This money should yield more money. So in that
Yeah,
perspective, it is like to keep it long term is better, correct?
yeah. Like if you can hold it for long term, yes, the chances of return are much more in that case. But again, if you can't hold it, let's say somebody has. I will give you one practical example. So, for example, you are holding cash of let's say 150K for your kids' college, which is 2 years down the line.
Mm.
Very practical scenario, right? You already saved the money, but since your college is 2 years down the line, you don't want to risk that money, and you are keeping it in your bank account because you know that after 2 years you have to start paying for college. Now, this money sitting in a bank account or in a high yield savings account or in a CD for 2 years, paying interest on it, better than that would be to put it into a principal protected note so that you don't lose the principal. You get your money back after 2 years when you start to pay for your college. So you know the principal is 100% protected. So from that point of view, you are secured. And plus, give yourself a better chance to earn more than the bank CD. Now, there are chances you may not earn. Yes, chances are there if market doesn't perform or underlying doesn't perform. But you are giving yourself a best chance to beat the at least whatever you are getting in bank CD. So
Okay.
that is one practical scenario. Another practical scenario could be, let's say, you are having your 401k or your IRAs account, and then you have like, let's say, 300, 400k into that, and whole of that is invested in some mutual fund, either target date mutual fund, which is like 70, 80 equity bond portfolio, or into some individual mutual funds or stocks or things like that, which is subjected to 100% market risk. Because market goes up and down, your 401k values or IRA values goes up and down. Now, you can take a portion of that out and invest in a long-term principal note. Let's say if you're 50-year-old or a 45-year-old or a 55-year-old, you know that you are not going to touch this money for next 5, 10 years anyway until you hit the retirement age. So why put it to 100% market risk? Anyway, you are taking market risk by investing into equity. Better to take these structure notes, part of it into structure notes, so that you can protect your losses in case market goes down in next 3, 4, 5 years. And once it matures, anyway, that entire money is again available to use it or invest it whichever way you want. You can again go for another structure note, or you can then invest as per your own wish at that time. So that can be another practical scenario to consider.
So, Prabhu, just from this point, like you said, from 401k, we can take the money with penalty and all those charges.
No, no, no,
Then,
no, no, no. Only old 401k. Let's say you have multiple jobs and you have old 401k sitting around,
okay,
or yeah,
rollover.
yeah, rollover. Yeah, right, right. So existing employer money you cannot touch. Existing employer 401k you cannot touch.
Yeah, okay.
Yeah, yeah. Or you have like cash saving, accumulated over a period of time, and you don't know what to do. You don't have any need for next 2 years, 3 years, 5 years, depending upon your situation. Then you can take a call. Hey, anyway, I'm not using this 100, 200, 500k for next 3 years anyway. I don't have any plan to use it for anything. So, but I don't have a guts, or I don't want to take risk to put everything into market at once, because
Prabhu, you're talking 100. Is it the minimum? Like 100k is minimum?
no, as I said, 1k is minimum, but
Okay, okay, okay.
yeah, but 100k is a decent size because you are paying 1% charge also, and then you want to get something out of it substantial. So I would say like 50k to 100k is the kind of minimum amount um, to 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 use for this. Then it will be a worth. Like you will get something substantial. Otherwise, the impact would be very, very minimal. This way or that way.
Okay. Sure, Prabhu.
Yeah.
And the main reason that this whole session you're conducting is because the market interest rates and everything is going down. So this might be
Yes.
beneficial, right?
Right. So because now expectation is that interest rate will keep going down as per the Fed mandate. Already it has come down by 0.75%. It will further go down. And another thing is that market volatility continue to remain due to political landscape now.
So, Prabhu, if market rates goes down, like interest rates goes down, that then real estate market will come up, right? I mean, that was what I see like last 4 years, right? 3 years back or whatever. So,
So house prices will go up further if interest rates come down substantially. because then that will boost demand again, and then chances are that prices will go up further. They will not come down.
So do you
So
have any suggestions like to invest in those kind of things then?
yeah, I had done another seminar on that, real estate investing. So
Uh-huh.
that is just my personal opinion, but again based on facts and figures and deep market study of it. So it's on my channel. You can refer to that. That will
Okay.
give you practical insights into it. Because there are lots of points you need to consider before you want to invest in that.
That will be nice. Thank you, Prabhu. I'll go through that then.
Yeah.
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 That's it, Prabhu. I'm good. Yeah. Thank you,
Okay.
Prabhu.
Thank you.
Thanks, Prabhu. Hare Krishna.
Hare Krishna. Okay. Any other final questions, comments? Okay, then thanks once again, everyone, for joining. And if any questions, then you can reach out to me. Thank you. Hare Krishna.